What's going on, traders? Today we're talking about price and price movements. Right now we're looking at the S&P 500, or the Standards and Poor's 500 index, or the SPY if you want to call it, and it is just the collection and index of the top 500 companies listed on the US stock exchange. And I want to explain all of this very simply, so if there's any questions, please put it in the comments and I will answer them to the best of my ability. Now we're looking at the S&P 500. If you were to, let's say, buy a share of the S&P 500 in 2009 for around $700 or $800 and sell it today for $5,300, you would make that difference of $4,500, $4,600 and make that profit. Now, this is why investing is so awesome, because you can buy something for a price one day and sell it for hopefully a higher price the next day and make that difference. And this is how millions of people around the world make money. And let's say I wanted to buy one share of the S&P 500. I would need to find a way to cough up $5,300 to buy just one share of the S&P 500. And this all comes from very basic economics concepts, supply and demand, or buying low and selling high. If we take all the people in this market that want to buy or want to sell a share of the S&P 500, we have millions and millions of people saying, hey, I'm willing to buy one share of the S&P 500 from a price of 0 all the way up to this price level of $5,304.71. And we have millions and millions of people who already have shares of the S&P 500 that are willing to sell it from a price of infinity all the way down to this price level. And over time, this price will move based on outlying orders and people willing to sell for XYZ price. But today, as of last Friday, it is at $5,300. But maybe on Monday, if it wants to push up, the amount of people willing to sell will say, hey, the amount of orders are drying up. I want to sell for a little bit more. I feel like the S&P 500 is worth just a little bit higher than $5,304.71. And everyone who's buying says, yeah, I agree. I'm willing to pay a little bit more for one more share of the S&P 500. And so that's what moves price upwards. Now, if we're looking at something like Peloton, where this is obviously in a downtrend, this isn't looking so great. This probably wouldn't be the smartest investment. If I were to buy a share from in 2001 of Peloton for around $160 and sell it today, I would lose almost all my money because it's only worth $3.15. And these are really the two shapes of what a market may look like. We're either in a bull or uptrend market, bullish market, and we call it this because of the way a bull attacks with its horns. It attacks upwards. Or we're in a bear market, and that's when we call it a bear market or a downtrend market because of the way a bear attacks with its claws. It will attack downwards. So this would be considered a bear market, while the S&P 500 would be a bull market. And typically we want to look for markets like the S&P 500 that we typically know based on recent history that price will likely move upwards. And we typically want to avoid something like Peloton that in recent years hasn't been doing great. And so we want to avoid this because we don't want to lose money. And price really moves in one of three ways. It either moves up, down, or sideways. And this comes from a very basic economics concept of supply and demand, or buying low and selling high. If there is the entire market of everyone who wants to buy a share of the S&P 500, there are millions upon millions of people wanting to buy a share of the S&P 500 for less than this price level, all the way down to 0. And there is millions and millions of people wanting to sell a share of the S&P 500 at this price level or higher. And this is so they can make a profit, so they can make money. But right now, the agreed upon price of one share is at $5,300, right around there. And price will move when someone from the buy side or the bid side says, hey, you know, the amount of shares that are being sold at this price right now is running thin. I'm willing to pay a little bit more for one more share of the S&P 500, and it will move up when the amount of shares being sold at this price run dry, and the people selling it say, hey, yeah, this is worth a little bit more. I'm going to sell it for a little bit higher, so the outlying shares start to move upwards. And then typically over time, the price of a certain asset will be moving up over a long period of time or be moving down over a long period of time. If we were to look at something like the British pound to USD, we would see that price can be sometimes inconsistent and can move up, down, sideways, and we can see this through higher highs and higher lows. And this is how price moves. Price will typically move in a higher high or a lower low fashion. Now, if we were to look at the Great British Pound, this can be a great example of what I mean by higher highs and lower lows. If we were to take price at the start of 2016, it comes down, then it starts moving up in a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and then a higher high. And there's a bunch of outlying orders right here, which, you know, tops it out. No one's willing to buy a one Great British Pound for more than $1 and 143 US dollars, and so the price starts to move downwards again in a lower low, a lower high, a lower low, and a lower high and a lower low fashion. So this is what we mean by higher highs and lower lows. It's really how tons and pretty much every single commodity in every market moves. You'll see this in even the S&P 500. You'll see a higher high, a lower low, a higher high, and a higher low. And this will push price upwards. We'll see this in Peloton too, where you see the high top to a low low, to a lower high, to a lower low, to a lower high, to a lower low. And this will bring it downwards. So we can really use higher highs and higher lows to see how price is kind of moving. If you're seeing this move up here, you know, this would be a great time to buy because it's moving in a higher high to a lower low fashion. Now, if you're looking at this, you know, and we start to see that price is breaking structure, coming to a lower low, to a lower high, to a lower low, to a lower high, to a lower low, you might say, hey, you know, price might be moving downwards. I want to cut my losses. Then maybe it's time to sell. And that's typically how price and price movements work. You see bear markets, bull markets, higher highs, higher lows, and that's what pushes price upwards and downwards. And we can go further in depth into those concepts later as well. It's pretty deep, but that's the very general concept of the whole thing. I hope you guys enjoyed.